Please come to next question number 34. P acquired 80% shares in S Limited on 1/7/2018, underline 1/7/18, and SOFP on 31st March 19. So 31st March 19. How many months are over? 9 months? 9 months. So if you have to prepare the profit and loss statement, then you have to take proportionate profit for the current year, 9 months only. Asset side, non-current asset PPE, investment in S Limited, current asset, inventory, other current assets, equity and liabilities, share capital, reserves and surplus, current liabilities. Then S Limited declared and paid dividend at the rate of 10% on 1st March 2019 out of post-acquisition profit. Then profit and loss account of the two companies for the year ended 31st March 19. Now this is the current year's P&L account. Revenue, tick tick, dividend from S Limited, we will eliminate. Then expenses, profit. Statement of changes in equity of P Limited, only P Limited. Retained earning, general reserve, total. Opening balance, add total comprehensive income. Statement of change in equity of subsidiary limited. Opening balance, add total comprehensive income, and then they have paid the dividend. Out of that dividend, you have seen in P&L account, parent has received the dividend, its share, 80%. Prepare consolidated SOFP, comma, right, comma, SOPL and SOPL both. Okay. So start. Which are the formats we will require? One, we will require this statement of financial position. We will require consolidated statement of profit and loss. Then we'll require consolidated statement of changes in equity. One analysis of profit also of the subsidiary, and one working note on goodwill. Done. So should we start now? Say yes. Property, plant, equipment. Is there any adjustment in property, plant, equipment? No. Take on your calculator. 6 plus 2 equal to 6 plus 2. Is it 8? Very good. Investment in S Limited. Goodwill working note. Consideration paid 10. Then inventory. Do we have adjustment in inventory? No. Take 5 plus 3. Is it 8? Other current asset. 2 plus 7. 9. Share capital. Parent company in SOFP also. And share capital right here also. How much is that? 15. Now wait a minute. For reserve and surplus, you have to refer that SOCIE of P Limited. Is it right? SOCIE of P Limited below. retained earning opening balance is 2 and general reserve opening balance is 1.52. So right here, general reserve opening balance as per SOCIE given to you, and retained earning opening balance 2. Then post acquisition we will write later. Subsidiary company share capital in the goodwill, how much is that? Is it 6? 6. And then subsidiary company SOCIE, you go to SOCIE of subsidiary company, you have some opening balance there, yes or no? So that opening balance of retained earning, which column? Pre column, because it is already in existence, write 1. And then opening balance of general reserve, how much? 1.6. That also in the pre-acquisition. And then you will find there is a total comprehensive income earned 2. Profit for the year. Profit for the year in the ratio of 3:9. 2 divided in the ratio of 3:9. 0.5. 1.5. Dividend paid, I will not first deduct and then I will add back. Is it right? This out of this dividend paid 0.60, 48 we will deduct from other income and NCI share will deduct from NCI. Parent company share will deduct here only. Is it right? And NCI share will deduct in SOCIE. So come to other income dividend. Just one adjustment I'll complete first. What is the income, other income appearing in the profit and loss? Dividend 0.48. 0.48, and out of that you deduct 0.48. 0.48. So this will become 0. And what about the remaining 0.12 that you deduct here? Less dividend received in NCI column, 0.12. I will not write in parent column. I have already deducted here. In this question, we are going to transfer this parent share in the SOCIE. And it has already been deducted once here. So if I write there also, it will get accounted 2 times. Okay? No. In some earlier problem, we had deducted there. But that earlier problem was for 3 years when we had deducted in SOCIE. Next line. Come back to your question. We are right now in SOFP. Reserve and surplus discussion is over. Then there is a current liability. Do we have adjustment here? No. Right. Current liability 3 plus 2, 5. S Limited declared and paid dividend 10% out of post acquisition profit that we have done. Profit and loss account of the two companies. So come to this P&L account. Remember, shares were acquired after 3 months. So we will start consolidating from the date of acquisition, that is from date of acquisition till year ending date, there are 9 months only. So every figure of subsidiary will multiply by 9 by 12. So how much will you write in sales here? Parent company is 15 and subsidiary you write 9 by 12 into how much is subsidiary? 10. So what is the final figure in the outer column? 22.50. Dividend adjustment I have done. So what is my total income here? If I draw a line, 22.50. Come to expenses. Same thing in expenses also. 14 plus 9 by 12 into into how much is that? 8. So how much it comes to? 20. So profit before tax 2.50. Do we have tax in this problem? No. So profit after tax 2.5. Share of profit attributable to NCI. So dear student, today one question for you. What is NCI share in the profit of the subsidiary? I am going to write here. 5 seconds will be allowed to you. Share of NCI. So first you do what you do, find out the profit of subsidiary company on standalone basis. Is it 2? In the question only 2 is appearing. Current year profit. And then you see here, is there any adjustment in the profit of subsidiary which I need to either plus or minus? No. So done. What is subsidiary share in this company's stake? 20%. So you will write 20% into what is the profit of this company? 20. However, we will multiply by 9 by 12. Entire year profit will not take. 9 by 12 only, because these figures are all 9 by 12. 9 by 12. So tell me the figure now, final figure. 20% of 20 into, not 20, sorry, 2 into 9 by 12. 2. This 20 I have written wrongly. 0.3. Okay. So parent share balancing figure 2.20. Total 2.50. Right. So this 0.30 and 2.20 right here, post acquisition profit. 2.20 retained earning column, 0.30 here in NCI column. Now let us come to this analysis of profit. Take total of the pre column. How much is the total of the pre column? Is it 3.10? 1.5. This 3.10 you transfer here. So this becomes 9.10. Now what is the valuation model for NCI in this question? Nothing is given. So we will assume proportionate method. 20% of 9.10. 1.82. So this is 11.82 minus 9.1. So that goodwill is 2.72. Okay, wait. Analysis of profit S Limited. Right here P Limited 80%. Post column 80% is how much? 1.20 and 20% 0.30. Goodwill, write down in the balance sheet goodwill. How much you said? 2.72. Okay, right. Then you come to this SOCIE. NCI on the date of acquisition, right? How much was NCI on the date of acquisition? 1.82. Is it right? You can write separately or you can write in first line. So tell me the total of each line first. 15 plus 1.52 plus 2 is how much? 18.52. And NCI 1.82, 0.12, this is 2.5. Now tell me the total. 15, 1.52, 4. हाँ जी 4.2, NCI 2, last column 22.72. Okay. This figure we have written already. What is the total of these two, general reserve and retained earning? 5.72. 5.72. NCI is 2. 5.72. Other equity right here. Is it 5.72? Total of these two is how much? And how much is NCI? 2. What is the total of the asset side? 27.72. And this one? Amazing. Done. Tallied. Which is the next question number now? 35. Question number 35. Only P&L account this time. P bought 70% of S on 1st July, underline 1st July 2016. 1st July 16, underline, following are the statement of profit or loss for year ended 31st March 17, underline 31st March 17. Count 1st July 16 to 31st March 17. Is it 9 months? So subsidiaries profit you will multiply by 9 by 12, all figures. Revenue, cost of sale, gross profit, operating expense, profit from operations, investment income, profit before tax, tax, profit for the year. The following information is available. On 1st July 2016, an item of plant in the books of S Limited had a fair value of 5,000 in excess of its carrying amount. So that you will adjust in the balance sheet, 5,000 appreciation. But the depreciation part will be adjusted in profit and loss. So it says at this time the plant had a remaining life of 10 years. 5,000 divided by 10. 500 is annual depreciation into 9 by 12. So you have to provide for additional depreciation in P&L account. Depreciation is charged to cost of sale, tick mark cost of sale, and you will add 375 more current year depreciation, additional depreciation on revaluation. During the post acquisition period, S Limited sold goods to P, upstream or downstream? Upstream. Will the NCI share get affected because of this? Yes. Of this amount, rupees 500 was included in the inventory of P at the year end. So 500 into S earns a 35% margin on its sales. Now it is given 35% margin on sale. So directly multiply 35% of 500. 175 is unrealized profit. Tick mark cost of sale again. Adjustment 1 and 2 both will affect cost of sale. Goodwill amounting to rupees 800 arose on the acquisition of S, which had been measured using fair value method, underline, so that while calculating the NCI share, you will adjust the impairment of goodwill also. Goodwill is impaired by 10% at the year end. Impairment loss should be charged to operating expense, tick mark operating expense. Then S Limited paid a dividend of 500 on 1st January 2017. Tick mark investment income. Out of that investment income, some portion of it is related to group company. So to that extent, we will reduce. Okay. Prepare consolidated statement of profit or loss. So only one item, consolidated profit and loss. So in one format we can complete this. When was the share acquired? 1st July. Year ending date 31st March. So be careful while solving the problem. So start sales. Do we have any intercompany sale here? Yes. Point number 2. During the post acquisition period, S had sold goods to P for 4400. So write down in the sales. How much is the sale of the parent company? 31,200. Subsidiary we will take 9 by 12. 9 by 12. Okay, multiplied by 10,400 and minus 4400. So how much is the final figure? 31,200 plus 9 by 12. Haji, final figure 34,600. Very good. Next, cost of sale. No, this entire sale is in the post acquisition period. This is the total sale of the post acquisition period, and out of this 4,400 is in the post acquisition period. This is post acquisition period sale, na? So I am removing from post acquisition only. Don't confuse. 9 by 12 into 10,400 is post acquisition total sale of the subsidiary. Correct? And post acquisition intergroup sale is 4,400. So I am removing from post to post only. Continue. Next line, cost of sale. Cost of sale P Limited. Write down full 17,800. S Limited 9 by 12 into 5600 4200 less intercompany purchases in bracket 4400. Okay, and then add unrealized profit on stock. Removing unrealized profit on closing stock will increase the cost of sale, and that calculation will be directly 35% into 500, 175. Is it 175? Okay, come back to your question. Cost of sale, gross profit will not write. Operating expenses, right? P Limited is how much? 8500. S Limited is how much? 9 by 12 of 9 by 12 of 3,200. Keep it here, we'll come back to this. Then profit from operation will calculate later. Investment income, right here, investment income. Parent company is 2,000. 2,000 minus 70% of dividend received from subsidiary. Subsidiary company has paid a dividend of 500 rupees in the last adjustment. So that comes to 350. 2,000 minus 350. 1650. 1650. So what is my total income here? Can you give me the total income figure? 36250. 36250. Okay. So that is investment income, profit before tax, taxation figure, right? 2100. Tax 2100 plus 9 by 12 into 500. 2475. 2475. Right. Taxation is over. Profit for the year will take calculate later. Adjustment number 1. On 1st July 2017, an item of plant in the books of S had a fair value of 5,000 in excess of carrying amount. This is a balance sheet adjustment. At this time, plant had a remaining life of 10 years. Depreciation is charged to cost of sale. So come to cost of sale. Write down add additional depreciation 5,000 divided by 10 into 9 months by 12 months. So how much it comes to? 300. And now you take this total in the outer column, this cost of sale. There are total 5 items. One is negative in the center. Total of cost of sale. Is it 18150? Wait, there is one adjustment pending. Point 2. During the post-acquisition period, S Limited sold goods to P Limited for rupees 4400. That we have done. Of this amount, 500 was included in the inventory of P at the year end. That also we have done. S Limited earned 35% margin on its sales. Adjustment number 3 is pending. Goodwill amounting to 800 arose on the acquisition of S, which had measured using the fair value method. Goodwill is impaired by 10%. Impairment loss charged to operating expense. So come to operating expense. Write down, add goodwill impairment. Goodwill impairment will be 10% into 800. 80. So total comes to 10,980. Is it right? So tell me the total of all expenses. Total of expenses how much? 29,130. So tell me profit before tax. $36,250 minus 29,130. 7,120 minus tax 2,475. 4,645. Share of profit attributable to NCI. Now I will give you 30 seconds to try your luck. Just give me the final amount. Share of profit attributable to NCI. To help you, I have highlighted 3 numbers also on the screen. Can you see 3 numbers are highlighted? So those will be adjusted from the profit. What is NCI share in the subsidiaries profit that I need to write? 105.75. Okay, one more try. NCI share is 30%. So first you write 30%. If you look at the question book, profit for the year, subsidiary is 1100. So first you take 9 by 12 into 1100. So this gives me post acquisition profit before making adjustments. Okay. And there are 3 post acquisition adjustment. One is this unrealized profit on stock. So minus 175. One is this additional depreciation. So minus 375. And because you have used fair value method for goodwill calculation, the impairment loss of goodwill will also be borne by NCI. So minus 80. So first take on your calculator 9 by 12 into 1000. Minus 175 unrealized profit on stock. It is upstream transaction. Minus 375 additional depreciation. Minus 80 impairment of goodwill. And then multiplied by 30%. 105 point. So is it 105.75? I think some calculation error. 58.50. 58.50. And then balancing figure 4645 minus 58.50. Parent share. How much is that? 45? 86.50. Very good. Total also write down and close the table. 4645. Is it right? Right. Any query on this question number 35? Now, some theory we'll discuss. Again, we'll start a long discussion on problem. So it's like a small break from problems. Come to paragraph 33. Paragraph 33. Preparation of consolidated cash flow. We are not going to solve a problem, only understand. All the items of cash flow from operating activity, investing activity and financing activities are to be added on line by line basis. Just like we do profit and loss, we'll prepare consolidated cash flow statement. Now, from the consolidated items, intercompany transaction should be eliminated. Loss of control. What do you mean by loss of control? So parent is no longer a parent. Subsidiary is no longer a subsidiary. So now that loss of control may result into different situations. From subsidiary, it can become a associate or joint venture, right? That means either you will have just significant influence or joint control. So from that day onwards, you will start applying IS 28 and you will not apply 10 IFRS 10. Or the second is an investment without any subsidiary, associate, joint venture relationship. Then you will apply IFRS 9 as usual, or no investment also. What is no investment? All shares are sold. Here you may hold some stake like 5, 10, 15%. Here you may hold 20, 30, 40%. So what is the treatment now? A parent can lose control on subsidiary with or without change in the ownership interest. Now what is with or without change? With change means you have sold the stake. From 70% you sold 40%. So now you are having 30% only. But what is without change in the ownership interest? Subsidiary may issue shares. Subsidiary may issue shares under some contract which subsidiary had entered into. Like for example, they may issue debenture holders equity shares. So then the total equity share goes up. But your stake may fall below 50% in that case. Or they may issue shares to under ESOP schemes. Okay, share based payment scheme. Your control can go down. So that is also loss of control. And once the loss of control takes place, we'll solve one problem also on this. That is, even though you have not done anything, you have lost the control because subsidiary has issued shares. For example, the existence of potential voting rights exercisable by another investor like convertible debenture holder, loan holder, which transfers the ability to govern the financial and operating policies of the subsidiary. However, change in ownership interests that do not result into loss of control shall be accounted for as equity transaction. Now this is like, suppose you are holding 100% share and then you sold 30% share. So now you are still holding 70%. So there is a change in ownership interest, but there is no loss of control. So it will be treated like a equity transaction, bank account debit. Okay. So you will raise funds and then it will also give rise to a reduction in your stake in the subsidiary. So to that extent, you will transfer that amount to NCI. To that extent, you will transfer the amount to NCI. So that 30% will value the net asset of the subsidiary on this date, and the 30% of that net asset will be transferred to NCI. Difference will be adjusted in profit and loss. Profit and loss, that will go to equity only. Then on the loss of control, directly in reserve. Why not in penal account? We'll adjust directly in the SOCI under retained earning. Accounting for loss of control. On loss of control, since the entity does not anymore control the economic resource. Now suppose you have lost the control, so you have to de-recognize now. Reverse of consolidation. When we consolidate, what entry do we pass? Consolidation entry on day one we had discussed. You will write net asset account debit of subsidiary. Okay. Then goodwill account debit. Then to NCI and to consideration. Now de-recognize. So you will receive money, bank account debit. NCI also will be de-recognized if you lose the control. This goodwill also we will de-recognize. This net asset we will remove. In case if you keep some stake with you, then you will bring one investment here. And if there is a profit and loss, then to profit and loss. So this is the entry will pass on losing the control. On loss of control, since the entity does not anymore control the economic resources, it shall de-recognize the asset and liability of the former subsidiary at its carrying amount on the date of loss of control. The non-controlling interests which were present in the entity, in the equity shall also be derecognized at their carrying amount on the date of loss of control, including their share on the component of equity attributable from the date of acquisition. So whatever is the NCI value, that is NCI value on the date of acquisition plus whatever NCI share in equity we have added so far, derecognize. Any consideration received in the transaction resulting into loss of control will be accounted at fair value. And during this entire process of accounting for loss of control, the resulting difference shall be recognized as a gain or loss in profit and loss account. Any investment of former subsidiary retained possible. Out of 100 you sold 80%, 20% retained. Out of 70 you sold 40%, say 30% retained, shall be valued at fair value. The fair value will become the cost of investment from this date onwards, when the loss of control results in either interest in associate or joint venture. That fair value becomes cost for the purpose of further accounting under IAS 28. Okay, and then you'll apply IAS 28 from that day onwards. Add any change in net asset in the carrying amount of investment if it increases, or minus any change in the net asset of associate or joint venture if it decreases. So that is IAS 28, very simple standard. Let us see the application of theory. What is the theory? Remove all the net asset, remove NCI, and difference adjust in the profit and loss. Any investment retained will be measured at fair value. Question number 14. Small question. Entity P sells at 20% interest in wholly owned subsidiary. Wholly owned subsidiary means how many shares we were holding earlier? 100%. To outside investor for rupees 100 lakh in cash. The carrying value of the subsidiary's net asset is 300 lakh, including goodwill of rupees 65 lakh from the subsidiary's initial acquisition. Pass journal entries to record the transaction. What is the amount received? 100 lakh. Have we lost the control? No. So therefore, it will be treated as change in ownership interest without loss of control. So I will receive cash. Complete in that answer sheet. Question number 14. The counting entry will be cash account debit 100 to NCI 20% of 300, that is 60, and the gain we will transfer to other equity 40, being gain on sale of interest in subsidiary. Then there is a note also I have written. As per IFRS 10, where proportion of the equity of NCI changes, then group shall adjust controlling and non-controlling interest, and difference between NCI is adjusted, and fair value of the consideration received is to be attributed to parents' other equity, that is 40 lakh. Try this. Another question, 15 number. Do yourself. Entity A acquired 60% of the entity B 2 years ago for 6,000. At that time, B's fair value was 10,000. It had net asset with a fair value of 6,000, which for the purpose of this example was same as book value. Goodwill of rupees 2,400 was recorded. How did you get this goodwill? 6,000 is your cost of acquisition and the net asset was 6,000 into 60%, 3,600. So your share in the net asset is 3,600. Difference between 6,000 and 3,600 is 2,400. Can you guess what is this method known as? Fair value method or proportionate share in net asset method? Proportionate share in net asset method. On 1st October 2080, entity A acquires a further 20% interest in entity B, taking its holding to 80%. So this is additional lot acquired from 60 to 80. At that time, the fair value of entity B was 20,000 and entity pays rupees 4,000 for the 20% interest. At the time of purchase of the fair value of entity B's net asset is 12,000 and the carrying amount of the NCI was 4,000. Pass journal entries to record the transaction. Now we are purchasing the share here. Is it right? We are acquiring more stake. Our stake will increase. NCI stake will decrease. Our stake will increase. NCI stake will decrease. So journal entry would be what is the net asset of the subsidiary on that date? 12,000. And carrying amount of this NCI is 4,000. NCI is holding 40% share on this date. 40% stake has a value of 4,000. So 20% stake will have how much value? Half of it? 2,000. So we are going to remove 2,000 NCI from consolidated financial statement. And how much did we pay for it? 4,000. To cash 4,000. Out of 4,000 NCI, half we have taken over. So half we will derecognize NCI, reduce NCI. Take half of 4,000. But to get that stake, we have to pay 4,000 rupees. Therefore, the difference will be treated as loss and you debit other equity, loss on acquisition of interest in subsidiary. Done. As per IFRS 10, where proportion of equity of NCI changes, then group shall adjust controlling and non-controlling interest. Any difference between NCI and fair value of consideration received will be attributed to parents' other equity, that is rupees 2,000 loss. Question number 16. Try yourself. I'll give you 10 seconds to try. First you will try. We have discussed one paragraph. If we are already holding the control and then further increase does not affect goodwill. Further decrease also not resulting into loss of control will not affect goodwill. Is it over? A Limited acquired 10% additional share of its 70% subsidiary. From 70 it has become 80. The following relevant information is available in respect of the change in NCI on the basis of SOFP finalized on 1420X0 rupees in 1000. Separate financial statement as on 131/3/20X0. Investment in subsidiary 70% at cost 14,000. Purchase price for additional 10% interest 2,600. Consolidated financial statement NCI 30% 6600. So for 30% their value is 6600. So if I take away 10% from them, what will be the proportionate value of NCI for 10%? 2200. 2200. Consolidated P&L account balance is 2000, goodwill is 600. The reporting date of subsidiary and parent is 31st March 20X0. Prepare notes showing adjustment for change of NCI. Should goodwill be adjusted for the change? No. So we'll write a note for that. First you write down the journal entry. Journal entry to be passed. How much consideration we have paid for this? 2,600. So to credit side to bank, log this figure 2,600. Then NCI proportionate amount 10/30 into 6,600. 2200. Balancing figure adjust in other equity 400. Okay. And then you will write the same note as per IFRS 10, where proportion of equity of NCI changes, then group shall adjust controlling and non-controlling interest, and any difference between NCI, that is 22 lakh, is adjusted, and fair value of consideration received, that is 26 lakh, to be attributed to parent in other equity, that is 4 lakh. And one more note, consolidated goodwill is not adjusted. Okay. Now one more question for today. Question number 17. A Limited acquired 70% share of B on 1420X0 when fair value of net asset of B Limited was rupees 200 lakh. During 20X0 20X1, B Limited made a profit of rupees 100 lakhs. Standalone and consolidated SOFP as on 31st March 20X1 are as follows. Now this is 20X1 balance sheet, standalone, AB and group. Goodwill 10, it will appear only in group column. Then PPE, investment, it will appear only in standalone. Okay, but it won't appear in group. Cash, other assets, equity. If you see equity share capital, only 200 is appearing in the total. Don't try to take this total. This 100 is not added in the group share capital. Other equity, again this will not be directly added. It gets distributed between pre-acquisition, post-acquisition. Post-acquisition gets distributed between parent and NCI. So it won't match on one-to-one basis. And then there is an NCI 90. What happened? Profit for the year 100 given already in the first line. Then on 1420X1, purchase consideration 150, 30% NCI 60, total 210, fair value of net asset 200, therefore goodwill 10. So they have given the detail of how this goodwill was calculated. Now A Limited purchases another 10% stake in B, which reduces NCI to 20%. What is the cost you paid for this? 32. What is the proportionate carrying amount of NCI for this 10% stake? 30. How this 30 has come? This is 90. So you purchased 1/3 of it. So 1/3 of it means 30. They were holding 30%, now they are holding 20% only. So the proportionate value of 10% stake will be 10 by 30 into 90, 30. And then they have wasted your time by giving the same information again. A Limited acquired another 10% stake in B Limited on 1420X0 at rupees 30 lakh. The proportionate carrying amount of NCI is 30 lakh. Show the standalone and consolidated SOFP of the group immediately after the change in NCI. So how the standalone figures will change? How the group figure will change? So this time you have to present it in the form of a balance sheet. What is the entry you will pass? One entry only. In separate financial statement, what entry will you pass? Separate statement, investment account debit to bank, 32, 32. And in the CFS, what entry will you pass? NCI account debit 30. But to bank you will write 32. Difference 2 will come on the debit side as a loss. So that you will adjust in equity, group equity. Okay. So first I am going to give you journal entry. Right there, journal entry. Other equity account debit to being loss on acquisition of interest in subsidiary to NCI debit 30 to bank 32. This is entry in the consolidated financial statement. In separate financial statement, investment will increase, cash will decrease. Now, dear student, have I given you this blank format? Start. You have to solve. In separate statement, investment will increase. I have written a hint also, 150 plus 32. Cash will decrease, 200 minus 32. B will not change. And in group financial statement, I have also given you this entry. So give the effect of this entry in 3 items in the group financial statement and you will get the answer. Is it over? Dear student, is it over? Say yes or no. No? Check the answer on the screen now. The answer is now on the screen. Check column by column. Now check the answer on the screen. In the standalone, investment increased by 32, cash reduced by 32. Remaining figure same. B will not get affected at all. So B's figures will remain same. Group cash figure will get reduced by 30. 32, sorry. Group cash will get reduced by 32. Then in the group other equity will reduce by 2 compared to previous answer, 870 minus 2. And in group the NCI will reduce by 30. So the effect of the 3 entries you have to give here. 3 effect. One is this, NCI will be affected, other equity will be affected, cash and bank will be affected. Remaining figures will remain the same in case there is no loss of control, only increase in the control. In IFRS 10, we do not adjust the goodwill if there is a subsequent acquisition after we have already acquired the control. Now we will continue tomorrow.